Keep watching to learn more about accelerated depreciation. I'm your host, Michael Scott. You've reached the video CPA, and today we're talking about accelerated depreciation. Accelerated depreciation is most commonly used in taxes, in tax preparation, and is something that you really need to know, especially if you're doing your own tax return. If you're not doing your own tax return, it helps you understand the tax return that someone else has prepared for you. So, welcome. I'm a CPA with 45 years of experience. I'm also a certified management accountant. I've got a master's degree in accounting, and I feel very confident about presenting this video to you and all of the videos about accounting and tax that I've presented in the past. So I'm glad you're here, and let's go ahead and learn more about accelerated depreciation. I want to remind you to subscribe to this program if you haven't, and for those of you that have, I certainly appreciate it. All right, let's get into it. The first thing we've got is our education disclaimer. I'm not going to say much about that. You see it on every video that I've done, and so just read that when you get a chance. Also, why do we calculate depreciation? It goes back to the matching principle of accounting. Accounting actually does have principles. And what it basically says, if you buy equipment for a piece of equipment for $10,000, and that equipment's going to last 7 years, instead of taking all that expense in 1 year, that equipment's going to produce revenue for the next 7 years, supposedly. And so you want to match the expenses of that equipment with the revenue that it's going to produce. And so you would depreciate the cost of that equipment over 7 years as well, so that the expenses and the revenue are matched up appropriately. So that's the matching principle of accounting, and that's why we depreciate. With accelerated depreciation, it's assumed that the depreciation will actually depreciate more in the first couple of years than it does in the later years. Tax depreciation, financial depreciation, we mentioned this in the prior video on straight line depreciation. The two may differ. So if you look at a tax return and then look at a financial statement, they may differ, and don't be alarmed by that. So accelerated depreciation is used primarily for taxes, and it's used for equipment and almost everything other than real estate in your tax depreciation area. So everything other than real estate. Let's talk about the components of the calculation then. You've got the amount, your purchase price. It could be adjusted by shipping. It could be adjusted by sales tax. Could be adjusted by installation cost. You've also got a useful life in there, which the tax regulators are going to define for you as far as tax goes. And then you've got a placed in service date as to when you started using it, and a depreciation convention. Now you'll notice here that I haven't included salvage value, because salvage value is not used much in taxes. You'll also notice that I haven't included land because, like I said earlier, it's not used in real estate, and you're not going to have any situations, at least with the current law, where land will come into play. It's not depreciable anyway, but you don't have to deduct it from your purchase price. It's not an adjustment to your purchase price. All right, depreciation conventions, they do complicate things quite a bit. Why we have them, I really don't know. I mean, I don't think they make that big of a difference, but the IRS must think they do, or the lawmakers. So mid-month convention is the first convention. It's used for real estate, so we don't need to talk about it as far as accelerated depreciation goes. The mid-quarter convention may come into play with your equipment and with other things. So 3, 5, 7, all these useful lives are affected by mid-quarter. The mid-quarter convention. So what the mid-quarter convention basically says is, if you purchase assets in the final quarter of the year, the final 3 months of the year, and those assets exceed 40% of the total assets that you've received and purchased during the year, well, then you've got to use the mid-quarter convention. And what the mid-quarter convention basically says is that for that quarter that you put it into service, you're only going to get half of the quarter, 1.5 months. And for that quarter that you take it out of service, you're going to only get 1.5 months in that quarter. So that's the mid-quarter convention. The one you'll be most familiar with and use the most is the half-year convention. The half-year convention assumes that you have put everything in service at the midpoint of the year. So for everything from January through September, it assumes the midpoint of the year. And what it basically says is you're going to get half-year depreciation for everything that you put in service that year, and a half-year depreciation for everything you take out of service when you take it out of service. What that's basically saying in some ways is that a 5-year property is going to depreciate over 5 years, but there's going to be some left. So in the 6th year, you're also going to have some depreciation that you're going to have to take into account. So that is the half-year convention. All right. Let's get into the accelerated depreciation methods. Some of the year's digits is an accelerated depreciation method, and declining balance variations are accelerated depreciation methods. The sum of the year's digits are seldom used for taxes. In fact, I don't see it used at all anymore for taxes. Could be used a little bit for financial accounting, but I haven't even seen that very much. Declining balance methods, if you use a declining balance without a factor, it's actually a slower depreciation method than what straight line depreciation is. But there are factors applied to it generally, and it could be 1.5 for 150% depreciation, and it could be 2 for 200% declining balance depreciation. You see both of those in taxes, 150% usually in farming and ranching, and 200% for everything else. So let's talk about some of the year's digits. Even though you may not use it very much, you need to understand kind of how it's calculated. So we've got an example here of $40,000 with a useful life of 5 years, and we're using the half-year convention on this. Am I right? So the sum of the year's digits is exactly what it says it is. You actually sum every number for that depreciation method. So if you've got a 5-year depreciation method, you're going to go 1 plus 2 plus 3 plus 4 plus 5. Take the sum of that, and it's 15. If it's a 7-year depreciation method, well, then you'll sum all those, and that comes up to 28, I believe. So with the sum of the year's digits depreciation, 15 is going to be divided into 5 for the first year, because your first year you'll take the most depreciation, 4 for the second year, 3 for the third year, and so on. So in the first year, 5 15ths equals 33%, and you're going to apply those percentages against your purchase price every year until it's exhausted. So in this case, 33% times $40,000 is going to equal depreciation of $13,200. Now, using the half-year convention, you're only going to get $6,600 for that first year. All right. So when you bring taxes into the equation, well, then you are going to have a 6th year of depreciation using some of the year's digits, because of the depreciation conventions that we have to use. But fairly easy, if you understand the convention, the method, it's fairly easy to compute the depreciation. And like I say, it's not used anymore very much at all. Double declining balance is used a great deal, and it's used for all your equipment, for your automobiles, for horses, cows, trucks, whatever you might think about. So the cost, again, $40,000, 5-year life, and half-year depreciation. With double declining balance, or any of the declining balance methods, you're first going to come up with a ratio, and that ratio is going to be 1 divided by the number of years that you're depreciating it over, the number of years in the useful life. In this case, the useful life is 5 years, so we're going to take 1 over 5, which is 1/5. That equals 20%. So the declining balance method without a factor is 20%. Once you apply a factor, for example, if it's 150% depreciation, it's a 1.5 factor, and you get 30% instead of 20. And if you double it for double declining balance, it's 40%. So that's the way those depreciation methods, those variations of the declining balance method work. So in year 1, you've got 40% is your rate times $40,000, which is your cost. So year one's depreciation is going to be $16,000. With the half-year convention, you're only going to be able to take $8,000 for tax purposes. Year two, you'll notice you're still using the 40% rate, which you use for all 5 years, really. But you're applying it towards a different amount. So it is a declining balance method. So in year two, you're going to take that $8,000 worth of depreciation subtracted from the $40,000, and so you're going to apply the 40% to the $32,000, and so on through the end of the 4 or 5 years. Now you'll notice if you were just using regular double declining balance without depreciation conventions in mind, this particular asset would depreciate fully at the end of 4 years. In fact, you'd have to limit the depreciation in the 4th year because you don't want to over depreciate the asset. But with the half-year convention, you'll see that you only take $8,000 during the 1st year, and so you actually go out to 6 years again because of the depreciation conventions. Now these percentages that I've got in here, especially for the 5th and 6th year, are based on the IRS tables, and they differ a little bit from what a standard double declining balance calculation would be. So I've used their numbers because those are the ones that we use primarily for tax depreciation. And I've got a table that I'll show you on the next slide that shows that. So that's double declining balance. If you were using 150% declining balance instead of the 40%, it would be 30%, like I say. So eventually you'll depreciate everything out, and then you're done with that particular asset. Okay, so your tables, and this is what they furnish. It's kind of hard to read, but this is for 3, 5, 7, 10, 15, and 20% property on a half-year convention using double declining balance, okay? So you'll see in the 5-year column it's 20% instead of 40%, and that's because of the half-year convention. So this table already has the half-year convention built in. In the 2nd year it's 32%, 3rd year 19.2%, and so on until you get to the 6th year where you're taking 5.76% depreciation. So these are the tables that makes it a lot easier. All you do is apply then your purchase price minus your adjusted purchase price times these percentages, and you don't have to worry about the declining balance calculation each year. It makes it much easier. So if you're doing that, I would suggest you use the tables, but the example that I showed you shows you how those tables were actually built and how that depreciation method is actually calculated. All right, appreciate you watching. For example, I got a free ebook for you for watching, and it's called Endocles First Contact. It's a book that I wrote with my daughter about a couple of years ago. It's an adventure book. I think you'll enjoy it. So if you'd like a copy of this in ebook format, send me an email to michael@bscottcpa.com, and I'll be glad to send you a e-copy of that book. Now let's go on and look at the accounting entries. Double declining balance accounting entries. First of all, we have to put our asset on the books. So the equipment is $40,000 that we purchased. And for example, in this case, we used $10,000 worth of cash, so we're going to credit cash, lowering the cash account by $10,000. And then we've got a mortgage note or a note payable here. It's probably more appropriate to use note payable than it is mortgage note, but that's $30,000. So your entry balances, you've got $40,000 set up in equipment, and then you've reduced your cash account by $10,000, and you've got a mortgage note on the books then, or a note payable of $30,000 as the liability. When you record the depreciation, your depreciation expense, which is an expense, a debit, is going to be $8,000 for the year. That's based on the half-year convention. And your accumulated depreciation is going to be $8,000. So the accumulated depreciation is actually a balance sheet account. It's called a contra account. It's a liability account in many ways, but it goes on the asset side of the balance sheet because it's a reduction in the fixed assets of that asset side. So called a contra account. So just remember on your balance sheet it goes on the, it's a reduction in the fixed asset area. All right, thanks for watching. If you've subscribed to the channel, thank you very much. I appreciate all the subscribers. If you haven't subscribed, hit the emblem below so you'll be updated on all of the videos that I produce for this channel, and all of them are tax and accounting related. They're not the most interesting, but they're things that you need to know when you're preparing a tax return or understanding a tax return, or looking at your financial statements and understanding your financial statements. So I think the next video that we will do is on depreciation recapture, and that'll be it on depreciation. So join me next time. Thank you very much. Bye.